How the war in the Middle East is already impacting mortgage rates in Canada. The escalating conflict in the Middle East is no longer just a geopolitical crisis. It is already sending ripple effects through global economies, including Canada's housing market. One of the clearest early impacts is being felt in mortgage rates, which are beginning to rise as uncertainty spreads. Rising oil prices trigger inflation fears. At the center of the issue is energy. The conflict has disrupted global oil supply routes, pushing prices higher and raising concerns about inflation worldwide. For Canada, this matters because higher energy costs feed directly into inflation. When inflation rises, lenders and investors demand higher returns, which leads to increased borrowing costs, including mortgages. Bond yields are climbing. Mortgage rates in Canada, especially fixed rates, are closely tied to government bond yields. As the war fuels inflation fears, investors are pushing bond yields higher. Experts note that once oil prices surged following the conflict, bond yields rose as well, and lenders quickly adjusted mortgage pricing in response. Recent data shows fixed mortgage rates have already increased by 5 to 15 basis points. 5-year bond yields have jumped as markets react to the crisis. Fixed mortgage rates already moving up. The impact isn't theoretical, it's already happening. Some reports indicate 5-year fixed mortgage rates have risen by about 0.25% since the conflict escalated. Lenders across Canada have begun adjusting rates upward in response to market volatility. For homeowners, even small increases can translate into significantly higher monthly payments, especially for those renewing mortgages in 2026. Bank of Canada facing tough decisions. The Bank of Canada is now navigating a more complicated economic landscape. While the central bank has kept its policy rate steady at 2.25%, it has acknowledged that the war is increasing volatility in both energy markets and financial systems. Economists say the conflict is reducing the likelihood of interest rate cuts, increasing the chance that rates stay higher for longer, adding uncertainty to future monetary policy decisions. Delayed relief for borrowers. Before the conflict, many Canadians were expecting relief in the form of lower rates in 2026. That outlook is now fading. Analysts warn that rate cuts may be delayed or canceled entirely. Borrowers could face higher renewal costs. Housing affordability may worsen in the short term. This is especially significant as more than 1 million Canadians are expected to renew their mortgages this year. Global trends reinforcing the impact. Canada is not alone. In the United States, mortgage rates have already climbed to 6.46%, driven by the same inflation fears linked to the conflict. Similar trends are emerging in the UK and other economies, showing how interconnected global financial systems are when it comes to housing costs. What it means for Canadians. For now, the war's impact on Canadian mortgage rates is still developing, but the direction is clear. Borrowing costs are rising. Rate cuts are becoming less likely. Economic uncertainty is increasing. If the conflict continues or intensifies, experts warn that the pressure on mortgage rates and on Canadian homeowners could grow even stronger. The bottom line: a war thousands of kilometers away is already influencing how much Canadians pay for their homes. Through rising oil prices, inflation fears, and shifting bond markets, the Middle East conflict is tightening financial conditions, proving once again that in today's global economy, local housing costs are deeply connected to world events.